Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information. Alec, welcome to the show, my friend.
Owen, good to be here. Big fan.
Big fan. So good to chat. We've spoken so many times over the years, but it dawned on me that I've never had either you or Bryce join just me one-on-one and have a good chat about equity modes, about your journey, and about what you guys are building. So I think this conversation is going to be great for anyone that's interested, is a fan of the equity mates, I guess, business and kind of, legacy you're building through time. So
I don't know about that, but yeah, it's nice to be on. We've spoken so much over the years, and I was saying before we started recording, it's rare that Bryce and I get split up, and we're normally a package deal. So hopefully I do him justice today.
I'm sure you will, mate. And I meant what I said about the whole legacy thing, because what you guys do is very influential in a lot of people's lives. So I'm sure we'll come to that in a moment. But I guess one question I wanted to ask you, because I was listening to your recent interview with Joe Aston, the author and journo who spent a lot of his career at the Australian Financial Review. And I did that in preparation for us speaking to Joe. And what I noticed in that was you have this really great ability to ask the right questions at the right time. And this isn't just like a podcast of bromance. It's more like how does anyone ask the right questions? And I think these types of skills for people will become more important as time goes on and technology takes the place of some of the traditional stuff. So I don't know, however you want to take this question, my friend, like whatever you want to do, however you want to explain this, like how do you, like individually, how do you go about preparing and asking the right questions?
It's a good question. I probably haven't thought about it as much as it may seem. I think there's probably some table stakes, and then there's some particular things that I really care about and that Bryce really cares about when we do an interview. And I think the first thing is you have to do the work. And I think one of the best interviewers I've ever listened to is Ezra Klein, who started Vox and is now at the New York Times. And as he was leaving Vox and went to the New York Times, he did like a wrap-up podcast. And that was one of the things he said. Like the amount of people out there that will interview an author but haven't read the book, or will interview an expert but haven't done the work to brush up on what they're experts on, you can tell the difference. And it's the difference between asking a generic question like, you know, what did you write this book about, Joe? Or asking a specific question. You know, we started that interview with a quote from 2017 from Jerry Harvey saying he wanted to, you know, flog and hang Joe Aston. And it's like just doing that work and reading the book and understanding the context allows you to be different and ask different questions. And I think that's probably the second part of the answer. And something that we really care about is you don't just want to be N+1 interview. You don't want to be, you know, stop 15 on a book tour or on a expert promoting their fund or anything like that. You want to do something that is worthy of your audience's time and give them something different, give them a different perspective, or, you know, a different view on the expert, or just something that they'll get to the end of it and take something new away from the conversation. So that's important to us, and that comes from putting the effort in and doing the work. But then I think the final thing is just, you know, what's that Malcolm Gladwell 10,000 hours rule? Like, I listen to a lot of podcasts, and I think you're always better at something if you love it. And I love media. I love this space. And I think listening to people who are a lot better than me has made me better. And I think whatever field we're in, we should be learning from the best and watching the best and trying to emulate what they do well.
I feel like you would have done more than 10,000 hours now. I mean,
probably, yeah. I mean, we've been podcasting for 8 years. I was listening to podcasts well before that, and I'd listen to multiple hours of podcasts a day. So yeah, you do the maths on that, but there's a lot in there.
Yeah. Yeah. It's interesting. Do you think that like being in this business and being in the business of asking good questions and researching and these types of things, do you think that this is like played out in any other respects of your life? Like if you're just chatting with friends or you're catching up with someone or you see someone on the street or whatever, do you find you have an ability to like talk to them in a way that's like more relatable or like on their level, so to speak, because you've had to practice about like understanding the mannerisms of a guest or focusing in on their interests?
Maybe. I'm sure if you ask my mates, they would say the only thing this podcast has been good for is really annoying ETF chat. But I think, like, I'm sure there is an element of that. But I think really the superpower when you're interviewing, when you're doing a podcast, or when you're just like meeting someone new, it's just being interested, like being genuinely interested and actively listening to what people are talking about and asking the next question. And I think people love, whether you've got a microphone in front of you or not, people love other people taking an interest in what they care about. And I think that's probably the universal lesson. Just be like genuinely and really interested in other people.
But do you ever have someone on the show that you're like, I'm not that interested, but I kind of got to fake it to make it?
Definitely. Yeah. And like you would have had the same, like you would have done hundreds of interviews, maybe even 1,000 interviews at this point. And you can definitely remember some of the best and some of the worst. And we're the same. Like, like there are some amazing investors out there. And then there are some investors that aren't that amazing. And then there's a middle ground, amazing investors that aren't great talking about what they're doing. But that's, I guess like that's the art of what we do. That's our responsibility in some ways to make the less interesting guest more interesting, to bring the best out of people.
Absolutely. I feel like there's like a 3-dimensional checkers or chess type reference in here somewhere, but oftentimes I feel like a lot of what I do when I talk to people, like even like this, right? Like you and I are having this conversation. However, there is a third person listening to this. And so a lot of the questions that I ask you are not for your or my benefit, or it's not necessarily for my benefit. It's probably for yours and theirs. Does that make sense?
Yeah, it does. Yeah. I know what you're saying. I also think the best podcasts when people are like really in their natural state is just when you're like a fly on a wall of a conversation. And, like if you think about the best podcasts in Australia, like you put Hamish and Andy at the top of the list, you'd put Shameless right up there as well. Like they are just friends having a chat. They're people that you want to be friends with, that you want to know. And it's that, like the classic thing about podcasting is people call it this like parasocial relationship where you feel like you build an audience with the hosts. And like I feel that with Hamish and Andy. Like if I saw them or Jack on the street, like I know so much about their lives. I know who they are. And, they're obviously playing for an audience, but it doesn't seem like it. And I think that's something that Bryce and I, we just try and have the chat that we would have if the mics weren't there and we had beer in front of us instead. We're pretty nerdy and some would say we're pretty boring, but like we just love it and we love talking about it. And I think that's been the beauty of podcasting for us.
Yeah, absolutely. You can tell that you enjoy it, I think, because you kind of do have that same conversational type attitude like you would if you were tuning into a Hamish and Andy episode where kind of everyone's in on the jokes. And it's never too serious, but it's a good topic to talk about. I feel like you guys do that really well. If we could go back to the doing the work comment that you had before, to give people a sense, and I'm happy to, like in any of these questions that I ask you, feel free to just just reply them straight back to me. But how much prep would you do for, say, like in the Joe Aston example, because that's maybe familiar to people at the time of recording, is like he's just come out with a book. He's a pretty like very well-established journalist, so you can find his stuff online. How much work would you, Bryce, or just like, or both of you do for something like that?
So for Joe Aston in particular, we both read the book, the Qantas book, and then we paid a fair bit of attention to some of the media he'd been doing around the book. So like he'd obviously been on 7:30 and he'd done a couple of like the bigger media platforms, but Batuta had also interviewed him at that stage, so I listened to that one. But then because we kind of saw that the Qantas conversation was pretty much done at that point. Like a lot of that narrative had played out, and the Anthony Albanese had been embroiled in it, and the National Senator Bridget McKenzie had disclosed her stuff. Like that story was well down the track. So we kind of realized that we had this opportunity to speak to Joe, and we wanted to go a bit broader. So then we started consuming some of his other stuff. He did a bit of a press run at the end of his time at the AFR. So I was listening to a bunch of interviews he did around that, reading some of the older stories that they sort of mentioned there, and that kind of formed the basis of a lot of the conversation. So however much at time that was.
That's a lot of time, because you guys do a lot of shows, right? Like you have the two primary channels, like you got Get Started Investing and the main Equity Mates channel. So you're doing a lot of content.
But like that's our job. Like we don't have real jobs aside from that, like you're trying to build a funds management business and do all this interesting stuff. We just talk shit on a podcast.
Yeah, but there's a lot of work that goes into that, because like I was chatting to a guy called Joe Walker recently, who runs a podcast by the same name.
Joe is one of our really good mates. We went to uni with him. Yeah.
Oh, did you really?
Yeah.
Yeah, interesting. Well, maybe he caught the bug from you for podcasting, or vice versa. Who knows? But I was chatting to him recently, and he was saying in some instances he'll do 200 hours of prep for a podcast.
Yeah, Joe is on another level. Do not think for a second I'm saying I do what Joe does. Joe produces sometimes one podcast a month because he does so much research. So
yeah. But I feel like like sure, there's like declining, I guess, rates of return as you spend more and more time, and you got to surface the right questions to ask people. But I feel like you guys do such a good job of that. And one thing you also don't seem to do, in my opinion, is you don't take your audience for granted. It's like you said before, like you want to bring them something new every time you hit record on the microphone. You really put in the effort. You front load a lot of that, like with the Twiggy interview as well. With Andrew Forrest, that was I thought another outstanding interview that you've done recently, where it was clear that you did a lot of work and you asked the right questions.
I appreciate that. Yeah. Now you're going to make me really self-conscious when I'm preparing for the next interview.
Yeah, someone's listening.
Yeah. Yeah. I don't know. Like I mean, like, number one, we love it. Number two, you're aware that people are giving up their time to speak to you as well, so you want to do a good job. Maybe it all comes from some deep-seated insecurity that I feel like I won't do a good job unless I put all this work in. But hey, it works, so let's roll with it.
Yeah, I'd like to hear the story of Equity Mates in your own words. You studied a Bachelor of Laws, so I assume maybe there was something in you that wanted to be a lawyer. I think maybe one of your siblings, if I'm not mistaken, maybe went down that path.
Yeah. And so, okay. Now who's done the work before an interview?
Yeah. Well, yeah. You got to pay attention.
Yeah.
And so for people that obviously, I'd say basically everyone that's listening to the show, watching it, has come across an Equity Mates podcast and tuned in and heard your voice and heard like the stuff that you guys do, but maybe they haven't heard how you and Bryce came together, like where your paths crossed, how that passion for investing was seeded, and kind of what that first year looked like. I'm really interested in that.
Yeah. So Bryce and I met at uni. We were down in Canberra, living in college together, and just were two, young guys who didn't really know what they were doing with their lives and liked the idea of starting a business. We had some shocking business ideas. And at the same time, Bryce had grown up in this family where he had learnt about investing, and I had grown up in a family where the way to build wealth in Australia was to save for a house deposit and then pay that mortgage off over your working life. And so I didn't really know anything about the stock market, and Bryce kind of opened my eyes to this whole world. And then after college, we were living in a share house together, and we wanted to do something business related. We were interested in investing. So I had the bright idea of let's start a blog. And thank God Bryce talked us out of a blog and suggested maybe starting a podcast instead, because I don't think blogs have gone from strength to strength since then. But then I moved to Melbourne in 2017, got a job at Coles, and Bryce was in Sydney working at Woolies. And we started this podcast remotely, and no one was listening. Like, it was 2017, podcasts weren't as big in Australia. There wasn't really a business model around podcasts. No one was really making money from it in Australia. But we didn't do it as a business. We did it to learn to invest. Like, the idea and like the reason for doing it and the reason that it would be worthwhile was we were hoping we would be better investors and make money from our investments. And it was just a good excuse to get people to talk to us. It's very easy to knock on someone's door and say, we're the biggest investing podcast in Australia, when we're the only investing podcast in Australia. So that's what we did. And no one listened. Like, the first episode we recorded outside, one microphone between two of us, birds and cars in the background. We didn't know how to edit. It was just, you're young and you're dumb and you've got no responsibilities, and so you can do stupid stuff like that. And we just kept doing it. And no one listened in the first year. We didn't make any money. 2018, for the first half of the year, no one was really listening. We didn't make any money. We got our first sponsor, I think, in the back end of 2018 or early 2019. And it just slowly just built over time. And I really do mean slowly. I mean like 2 or 3 years before it was like, oh, there could be something here. But we both kept our day jobs, and, so we weren't worried about money. We were learning a lot. It was a nice way to keep in touch. I was in Melbourne, he was in Sydney. So I think, we just kept going, and then, the rest is history. I guess COVID was good, and I moved back to Sydney. We quit our jobs and we threw everything at the wall.
How did you know when it was the right time to quit your jobs?
I don't think there's ever a good answer to that question. It is context dependent. For us, it was when we got that feeling that we were missing opportunities because of it. There were things we couldn't do, or just that we were missing opportunities, and we felt we were kind of not letting it slip through our fingers, but we just knew, if you have this sort of regret minimization framework, it's like there's always going to be another job. But if you let this opportunity slip and the audience dwindles and you don't really try and make the most of it, are you going to regret this in 3 or 5 years? And so with that in mind, we kind of thought, okay, let's give this a crack. I quit my job and moved back to Sydney. Bryce asked for a year of unpaid leave, so maybe read into the different levels of commitment as you will. But very quickly, Bryce realized he wasn't going back to his job, and I think. Look, there was no way if we quit our jobs in, end of 2017, start of 2018, there's no way we would be speaking today. Like, it wouldn't have worked. The audience wasn't there. The revenue wasn't there. We would have had to, give up and go back to our jobs. So I think holding on to that paycheck for as long as possible was super valuable. And then it was at that moment when we were like, okay, there's enough here. Let's go all in.
You said before that it was like you got that first sponsor. Folks listening to this or watching it would probably have heard an ad on the front of the show. How does, like, for just a really low-hanging fruit, but like, how does equity make money? Like, how were you in those early days and today able to like make money?
Yeah, it's advertising, and like our dream, I think most media people's dream is to find a way to diversify away from the advertising revenue model, but it is hard. So look, it's the oldest profession in the world, or the second oldest profession in the world. Get people's attention and put ads against it. And like the medium changes, but the business model doesn't, from newspapers to radios to, the first generation of the internet with display advertising, TV I missed there. But, it is all the same. Just get people's attention and put ads against it. And we're no different. There are obviously nuances with each medium and with each industry. Like finance advertising is different to, general consumer and podcast advertising is different to display advertising on websites. But at its core, it's all the same. And it's a lot of the same players and a lot of the same media buyers. And then, we're really keen to build out other revenue streams that don't rely on advertising. But not heaps of people want to pay for premium podcasts or, not everyone's the fund manager that you are, Owen, and can build an investment product. So, at this stage, you've got to cop the pre, mid, and post-roll ads.
Oh, and thank you. Very charitable with that compliment. But when it, obviously when the business started to take off and because it became in many investors' daily, there was an equity mates something or other, whether they jumped on the mailing list or whether it was listening to an episode or sharing it with friends. When that started to take off, I feel like other media brands or finance brands would have seen that and approached you guys, right? Because it's super valuable what you do, at least in my opinion, it's super valuable what you do. Did you get approached in the early days from anyone to be like, hey, what you're doing is great, we'll have that?
To buy us?
Yeah.
Yeah, look, those conversations have happened over the years, but it's very much a nice idea. And then all of a sudden it's like, oh, well, hold on. If, let's say Rask Invest bought Equity Mates and all of a sudden then all Rask Invest wants is for us to promote Rask Invest, then all of a sudden our revenue kind of goes to zero. Or a lot of our revenue goes away, and then it's like, okay, well, how do you value this just on the reach and the media and stuff like that? And are we as authentic and independent messages once Rask Invest buys us? So those are the conversations, and they become the stumbling blocks. And look, don't get me wrong, an acquisition is certainly it would be nice, and if anyone's listening, we're happy to chat, but realistically, I think what we want to do is kind of build something that's useful for everyday investors. And if the best way to do that is to do it independently, so we can kind of keep our voice and keep what we're doing separate, then that's the path we should go down. Obviously, having the balance sheet of a product issuer or something like that would be able to help us do some things, but it would hinder us in other ways. So look, the conversations have happened. They're always a massive distraction when they do happen and you start imagining what your life would look like. But I think what we've learned is to try and, just focus on what we're doing and not get too excited by it all.
Yeah, because I guess that's one of the things, isn't it? Thinking about the different mechanisms of a business, where value is created, where revenue streams come from, so important. But I hear exactly what you're saying. That loss of focus is also a big deal. I feel like there's so many things already in business that can distract you. So that's a big one too. And the reason I asked that question, mate, is actually it's more because I hear you guys joke about the exit that you might get on the show. So I always just think about that in the back of my mind. You said, at the top of the show that this is one of the rarer times that you get to do a long form interview, by yourself without Bryce beside you. I often I tried really hard when I started Rask to get someone to effectively be a co-founder with me. It was really difficult. Just people in different times of their lives and those types of things. And I just couldn't find one, right? And I really wanted that because I felt like there would have been a sounding board. There would have been a sense check in a house, someone that I could just go to and they get everything. There was no explanation needed. And now that the business has scaled for you, I'm curious where you guys choose to divide and where you guys choose to unite to conquer, in the sense that Like, do you guys have specific responsibilities? It's not always you come across co-founders that have been together for so long.
Yeah, I mean, look, there's no way I would be here without Bryce. I hope he would say the same thing about me, but I actually don't know if it would be. I don't know if it would be true if he said it. Like people say, don't go into business with your friends, and I think go into business with your friends. Like if you're both really aligned on what you're trying to do, and it's not that Bryce and I like both had like a clear 10-year plan, and this is what we want to try and execute, but just like from where we were in life and like what our values were and what we thought was important and what we were trying to get out of the business. Like, I think we were really aligned and it's really worked. And I mean, I'm sure you can attest to this, like building a business can be pretty lonely. And often the challenges that you face, you don't want to put onto your employees. And then like the people around you who love you and support you don't really get it as well. Like your parents love you, your partner loves you, but they're not in it in the same way. And so having that co-founder relationship just has always meant there's someone in it. And I don't say this to rub it in after you just gave that intro to the question there, Owen, but for people listening, I think it's been really valuable and certainly wouldn't be here without Bryce. In terms of the second part of your question around how we divide responsibilities, I think like at a high level, I'm probably more the content guy and Bryce is the business guy. It's just that Bryce is pretty good at content as well. So he definitely plays a CEO role, I guess, people management, sales, and then like a lot of the content initiatives and just a lot of the I guess the grunt work of actually producing the content will sort of fall on my side of the fence.
It's I remember you made a remark to me one day that you guys, and you in particular, just want to be really good at content. Like you want to be really good. And I think you guys are, like you guys like your ability to kind of, like I said at the top of the show, ask the right questions. The reason I asked that is because I think that you're like, if not the best in our business, you're definitely one of the best in our business, like our industry, at asking the right questions at the right time. But you do that in a way where you've got that kind of third dimension, as I was saying, with like the listener, you're asking it through their lens as well. And you make sure you don't miss those things, which is really important. Whereas a lot of hosts can end up producing a podcast for themselves rather than their audience as well. So I find that you do that really, really well. If I was going to ask you to forecast like where equity might go in the future, like you mentioned before about diversifying revenue streams, obviously you guys have got newsletters, you're massive on socials. You did a huge event a couple of years ago. You did a couple recently called FinFest. If anyone that wasn't there, Sydney, Barangaroo, it was just amazing, man. I just absolutely love that. It was so good. So many people in one place at one time. And all like it's so good to see different like people of different age groups, men and women, like all in the same room. It was just great. But like, I don't know if you do this. I don't know if you do like medium or long-term planning as a business, or if it's more like what are our sprints and our cadence, is a year or something. But I'm just curious, like where you think the business could go.
Yeah. Look, we ask that question all the time, obviously, and I think you got to take it with a grain of salt, because if you went back at any 3-year period of the business and asked where we would be in 3 years, like completely different to where we actually were. So I think, like we've got a really great community that's been built around the podcast. And I think what the first thing is just to like nurture that community and be useful to that community and like really try and understand where everyday investors are and what the pain points are and where we can be helpful. And so that's, for a lot of our journey, it's just been about like making the share market more accessible, understanding what's out there these days with the huge explosion of new ETFs and investment products and minimums coming down in unlisted products and all of that stuff. I think we have a real role in helping people filter and navigate the investment opportunities in front of them. And so that's going to be step one. But we know that like two guys talking on a podcast isn't the most helpful, and that a lot of people want different things beyond that. And we spend a lot of time talking about the advice gap. I think, well, I know the numbers are pretty stark. Before the Royal Commission, 29,000 financial advisors. Now it's about 15,000. But I think, the big stat for me is 15 years ago, 20% of Australians had an advisor. Now it's 10%, and those numbers aren't going in the right direction. So it's like, for so many people, because they can't access advice, they turn to podcasts like you and podcasts like us. And it's like, where can we play more of a role there beyond media? So would love to do more there. Obviously, regulation stands in the way, and, in theory, that's meant to change after the quality of advice review, but we'll see once the super funds stop negotiating with the government and, we see something pass. And then, I don't know after that. I think like we've got heaps of ideas. The challenge is we don't have a heap of money and neither of us can code. So it's like, what can we do with those constraints? But yeah, look, we've got ideas, and we want to do more events. We want to do more media, but then we really do want to go beyond media and try and think about where the actual pain points are. No one needs another podcast, but people do need help with their finances. Australia as a whole needs help with financial literacy. I'd love just generally as a point, I think, so there's so much great financial education that requires people to opt in, like to choose to listen to a podcast, to choose to download or sign up to Rask Invest, to, choose to sign up to Pocketsmith or whatever the platform is. But for me, like something that I have been speaking a lot about in the office and something that I've been thinking a lot about is like, how do you reach people in those places where they don't opt in? Dolomites was a predatory program that helped CBA have the lowest customer acquisition cost in the game. But for 90 years, it was the one program that reached into schools and spoke to people where they didn't have to choose to opt in. And I think it was the right call getting rid of Dolomites. It was the wrong call to not replace it with anything. And so stuff like that, schools, workplaces, universities, just other spaces where we can really try and engage people before they make the decision to opt in, is something that I'd love to be useful in.
Yeah, and see, it's that type of thinking, mate, that is the kind of thing where it's let it show with like the legacy idea, right? Like you said you can't code, you don't have the money to take on those massive ambitions, some of the massive ambitions, right? But one thing you do have is an intensely loyal community that love what you guys do, and they trust you and they trust the brand now. And so that is something that you can leverage as well, right? To help you do those things and, to mobilize the community to build education and those types of things that could one day potentially be used in that way, right?
Yeah, I mean, there's a lot of potential, don't get me wrong. Like we've built a great platform. There's heaps of connections we've made and heaps of people that are keen to help and who are passionate about this as well. So I guess watch this space / if anyone has any good ideas, hit us up and let me know.
I given your focus on content, I did want to ask you a question, and I'm going to ask you this maybe in reverse order. Is like, if you look across the media landscape, not necessarily in our pocket, which is kind of like finance, investing, business type thing, but if you could look at like one media company in Australia that you think, if I could buy that, that's the one that I would want. Like, what's a really good asset? It could be public, could be private, could be just a channel, could be something totally different. Like, I'm just curious what that would be.
Well, I mean, the obvious answer is News Corp, strip out all the media assets and just walk away with REA. But I'll take the question as it was intended around the actual media. I think there's a new generation of like really interesting digital media companies that have sort of taken the first step into becoming media, like they've gone beyond their sort of first show or their first platform and they're becoming media companies. And I reckon like that's going to be the trend to watch. Mia Friedman did it a generation before, but like what the Shameless girls are doing is like just incredibly impressive. What TDA, the Daily Oz, is doing is equally just really impressive. Even in the sports section, you know, like Dill Buckley and what he's done with Clubby, Dan Gorringe, like there's a lot of really interesting digital creators. The Batuta guys who seem to produce every second podcast in Australia under their Diamantina brand have obviously been doing the damn thing for close to a decade now, and they're really impressive. So I think for me, the legacy media is deleveraging in a terrible way. Like they've got way too high fixed cost. They can't afford, you know, they can't service their cost base. Audiences are declining, revenue is declining on the back of that. Like there is going to be people that fill that space as these companies continue to decline. And for me, it's like these people that have built an audience digitally, then moving into new and interesting spaces will be interesting. Like, yeah. So I know I gave you a bit of a laundry list, and I'm not sure who it will be, but I think there's a generation of like media entrepreneurs that probably don't think of themselves as the next Rupert Murdochs that in hindsight will build like really compelling businesses from a starting point, which is like the unit economics in media when you hit scale, on digital media when you hit scale are great. Like you're a software investor and you're looking for operating leverage. You're looking for a company that, you know, can have 70, 80% gross margins, and, you know, like every incremental dollar of revenue just flows beautifully to the bottom line. Well, the great thing is in digital media, a lot of that unit economics plays out as well. You have a pretty low fixed cost, but then next to no variable cost. Like the cost of distribution is now zero because of the internet. You know, if the Daily Oz get 1 million podcast downloads or 10 million podcast downloads, it costs them the same to produce that piece of content. So I think we think about media as a business with terrible unit economics, and it sucks when you're small, but when you get to scale, it starts to look really nice. And so those would be the businesses that I'm looking at. Have I sufficiently talked without answering your question?
Yeah, I'm going to come back to that. Don't you worry about that. Don't you worry about that. I wanted to follow up on one of the first points you made, which is like traditional media has like really bad economics in terms of like this high fixed cost. Can you just maybe double click on that for a moment? Just tell for some of our older generation listeners and viewers as well, this might be really interesting. It's an insight into like, what do you mean by that?
Well, I mean, like just at a very simple level, like if you think about the marketplace in which these guys compete on, it is a standard marketplace. Like there is no differentiating between a New York Times article online and a Vox.com article online, and then a AI generated, you know, Estonian click bot farm article online. Like they're all presented the same. They all interacted with the same. And unfortunately for the New York Times, they all have the same unit economics in terms of the ad revenue that they get from Google. And that was really the New York Times insight about a decade ago. Like they are my favorite media case study because they bucked the trend and they did a lot of really hard work to really build their subscription business. And now they're really like, they are the gold standard in legacy media in terms of building a subscription business and kind of getting away from the declining CPMs, the declining ad revenue. But unfortunately for the likes of, you know, Sky News and 7 and 9 Entertainment, like they're competing with people who have far lower cost to produce content that looks more or less the same as them. And it's not even the cost of production, it's also the cost of talent these days. Like the astronomical paychecks that TV and radio talent get is just a structural disadvantage against YouTubers and podcasters and people like us who are happy to work for free, basically. And you look at strategies like, you know, Sky News is a classic example, like News Corp owned legacy media who are pushing incredibly hard into YouTube. And like that strategy has by and large been successful for them. Like they are building a big YouTube audience. They're building a big YouTube audience in America as well. And so like they must be feeling good. Their subscriber numbers are growing on YouTube. But the problem for them, the structural impediment for them is that they're going to always be competing with people who can produce content at a lower cost and will be happy to take a lower return for that content. And that is the structural problem that exists with legacy media. And you've got to find a way to reduce your cost base, or do what the New York Times has done and get people off these platforms where you're side by side with people who can compete at a lower cost and are happy to take a lower revenue. But that's hard to do because that's where the audiences are these days.
So what did they do that was so interesting? Is it because do they have an app, or did they is it up through a mailing list, or is it all because the Australian, which is a Sky News service, right? That's behind a paywall.
So the New York Times, the first thing they were the first to say everything's behind a paywall, we're doing it, and everyone has kind of followed in that space. And then they split out a number of their services to get people in to their ecosystem and onto their app and into their subscriptions without paying for news. So New York Times Cooking has been a big success. New York Times Games came a little bit later, and that was also a success. But then what they did was they really invested in their digital offering. So they've become an incredibly digital first media organization in a way that everyone's just trying to catch up with. But they also really invested in their talent and their journalist talent. And they've just created this flywheel where they use the talent that they've got to get more subscribers. And then they use that subscriber revenue that they've got to invest in the best reporters, which attracts more subscribers, which attracts the best reporters. And it's just this nice little, I guess they've built their own ecosystem and they've built their flywheel that gives them a little bit of breathing space from a lot of their competition. And in the years since, a lot of other media organizations tried to follow the Times playbook. They stopped distributing stuff for free on the social media channels, and they tried to go subscriber first rather than digital ad revenue first. The challenge is not many people want to pay for multiple news subscriptions. So there was a real first mover advantage that the New York Times picked up on.
How about you guys? You guys have different channels, different mediums of which people can access what you guys do. Is that something that you consciously make a choice about? Which podcasts do you seed with new things, and which ones do you just support others? For us, for example, we might test an idea in an existing channel before launching it as a standalone channel. And I feel that's a way for us to de-risk it, but there could be other ways to do that. But you guys seem to have done that pretty well.
No, I think we haven't done it that well. I think what we've done well is try a lot of things and cut bait when things aren't working. Or to be honest, we've cut bait on things that were working, but we were losing money on. The classic example for me is The Dive, which was our daily business news show. And it was great. We loved doing it. It won Best Business Podcast at the Australian Podcast Awards. It was, for all intents and purposes, a success. But it was taking too much time, costing too much, and we weren't making enough back. So we put it on the shelf and we said, if we can't do this in a way that is profitable, we can't do it, essentially. And so I think that's the thing. You got to try a lot of things and cut what's not working and not fall in love with things that you're enjoying doing. So yeah, I think we have this view that you got to meet your audience where they are. Everything I just said about the New York Times doesn't apply for us. We're not the New York Times. We can't get people to, consume content on our website rather than on the social media sites that they're on. And so you've got to meet them on the social media sites that they're on. Yeah, we're just going to try and be everywhere.
I remember years ago, I was hey, I asked you, this was just a completely random question. I was hey, where are you seeing a lot of growth? And at the time you said TikTok, right? And that's maybe an illustration of that is now you guys are crushing it on TikTok. You have a massive Instagram following. Your emails, your game on emails and newsletters has picked up massively. You've obviously got the core podcast as well. So you kind of have demonstrated that you can do that and you can meet them on those channels, which is really, really interesting. I've got two quick questions that are more story arc related. I was thinking of asking you questions, given what you know, given the hundreds of guests that you've spoken to about ETFs. But I've got two questions that are exactly the same, but for different things. One of them, the question goes like this: if like out of 10, and a 1 being like we're in the early adopter phase, barely anyone's heard about this, to like we're in decline at number 10, where do you think like podcasts as a medium are in that spectrum?
Interesting. Well, I mean, I should say number 1 because that helps me, and we've got a massive runway to go. But I'm not sure if it's a bell curve. I'm not sure if it's like it's 1 and then there's growth and then we come down the other side, and 10 is the other side of that bell curve. Because I think we've passed peak podcast in terms of the raw number of podcasts out there, but I think we're still at 3 or 4 in terms of the listeners coming across to podcasting. Like radio is still the biggest audio medium. Don't ask me why, but it's still well, I'll tell you why. Cars and work sites, and podcasting is coming for both of those listening modes. And advertising dollars will follow audience, and so I think podcasting still has a way to go in terms of maturing as a business. And for me, I think probably do you know Carlotta Perez? She's written books on how innovation gets, I guess, distilled through society, and she's kind of speaks about 2 phases. There's an installation phase and a deployment phase, and the installation phase kind of starts with the technological disruption, and then it leads to a massive bubble or like a boom. And you could, the classic example is like the internet boom of the late 1990s, but you can go back through history and you can see a whole bunch of them throughout. The automobile coming in at the start of the 20th century just led to this massive flood of capital into the space, and literally thousands of startups trying to make cars. And at the end of the installation phase is generally a bust, and people realized that there was too much money and valuations were stretched and it wasn't logical. And then what comes out of the bust is the deployment phase. And with the internet, we can think about the mid-2000s emergence of the tech giants. But in the example of the automobile, we can think about in the US the emergence of the big 3 car makers out of that bust. And that kind of plays out over and over again. And so if you think about podcasting, it's obviously not quite the technological disruption of the internet or cars, but there was this breakthrough of people, realizing that podcasting was here and was a medium, and there was a flurry of people that tried to start podcasts, and heaps of money went into the space. And you can look at the money that was being thrown around by the Spotifys and the Amazons of the world. Like, it got way too hot, way too many people tried to start podcasts, and really 2020 was I guess like a mini bust for that. Spotify had spent billions of dollars on podcasting. They pulled back. A lot of people that got big deals from the big platforms couldn't renew their deals, or the money just wasn't there in the same amount. A lot of people shut their podcasts in that time. And I think what's emerging out of the other side is kind of this deployment phase where it's like, okay, podcasting is a medium where it's growing and there will be interesting businesses that emerge out of it. But, is Rogan worth 200 million? Is Alex Cooper worth 80 million? Like, some of the peaks of the valuations may not be repeated. But we're going to see like real and interesting podcasts emerge. So for me, like, that's where we're at. We're never going to see as many podcasts as we did in 2020 and 2021. But I think we're going to see more real podcast businesses emerge.
I love that answer, mate. That's awesome. I think that's like a really neat way to describe it. How about then if I asked you the same question, but instead of podcasts, we take ETFs, which I know a lot of the Equity Mates community absolutely love and invest in. How far along that do you think we are?
Yeah, it's a good question. I would actually be interested to get your thoughts on this. I mean, I'll answer your question, but I reckon you'd have a more intelligent take than I would. But I guess my 2 cents would be, you read a lot about a passive bubble, and you read a lot about, people like Michael Burry saying, if we have too much inflows into passive, then the price discovery mechanism of the market will be distorted, and that's going to lead to all kinds of harms. And I read that and I worry that we're on this podcast spruiking index investing and ETFs, and what if we're wrong? And yeah. But then on the other hand, we recently caught up with Alex Renehan from Beta Shares, and he had some stats that I think 6% of managed fund investment in Australia is in ETFs or in passive ETFs. And if you look over in the States, it's like 20%. In the UK, it's in the mid-teens or something. So in that sense, Australia still has so far to go compared to some of these other countries. And, active management still dominates, even if passive ETFs dominate inflows. And so I guess I don't have a good answer. What I would say though is any concern I have around, there's too much investment in passive ETFs is then far outweighed by what's happening with pension funds and super funds. The Australian superannuation industry is like $4 trillion. We barely scratch the surface as everyday investors. So I'd worry far more about what's happening there than for the rest of us. And if there's going to be a passive investment bubble, it's because super funds are forced to hug the index more than everyday investors. So yeah, I think like the innovation that is ETFs, or the innovation that was index investing in the 1970s, and then the innovation that was ETFs in the 1990s have been like incredibly good for everyday investors. And I think, it's only got more to run. But where we are on that journey and how big passive index investing can get and all of that stuff, I don't know. What do you think?
Yeah, I don't know either. It's probably the quick and easy answer. I don't know. And what I would say is that I think there's, like you answered with your question before, there's like multiple lines of context. And maybe one of those is that like we've got, 400 ETFs in Australia, thousands overseas. I think like the low-hanging fruit has been kind of sown in terms of, you see like the big ETF issuers. You mentioned Beta Shares, Vanguard, BlackRock, VanEck, GlobalX, and State Street here in Australia. And they got a lot of core products and what have you. And the newer ETF seems to be like tilts on different things, and there's a lot more active ETFs coming to that landscape. So I think what is an ETF historically has been an index ETF predominantly, not always, but increasingly there's going to be more active funds seeing that. I think like if you look at the big emerging threat out of the US, there's like a lot of direct indexing, which is this idea that if you can bring down the cost of trading, so the brokerage cost effectively comes to zero, what's to stop you having your own DIY ETF? Like I want one with, I don't know, that only sells drinks. So like Woolworths, Coca-Cola, blah, 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 blah. And it has to be ethical. And then you're left with like nothing. But anyway, bad example. You get the idea. Is like you could just go in, press a button and say, I like this, don't like that. I want this. And some tech finance thing will happen where it kind of like bundles it all up in an ETF, and it'll be called the Alec ETF, I think that's more likely. And we can already see that with financial advisors and the tools they use, like Hub, NetWealth, Macquarie, those types of platforms are already kind of doing that just in a custodial model. So I know that's really deep for the discussion, but basically I think that's the iteration, is like you can have like a Coke post mix, but you can also mix your own. Mm-hmm. And I think for most people, the kind of off the shelf ETF is absolutely totally fine. But I think increasingly people are going to search for things that aren't traditional market cap weighted investments and mix their own. Yeah. Some investors will, not everyone. I don't think it's like a threat. I just think it's like something that people will move to. Yeah,
look, I think if people are listening to this and worried about, ETFs, like don't worry. There's plenty of runway still to go, and they're the best investment vehicle for everyday investors that can't access the wealth platforms like NetWealth and Hub. And yeah, I think They've been an unequivocal good innovation, and there's too many. No one needs 400 ETFs, but I think the trend that we're really excited by now is a lot of the active managers that had $20 or $30 or $50,000 minimums, and then were only accessible on the wealth platforms, are now coming to market, and more choice is good for investors.
Yeah, I agree with that. Amen. Okay, so I've got just a couple more questions. I would be remiss not to ask you. One of them is like, of all the guests and things, I did send you these questions in advance. So whether or not you had time to think about them, but I was just really interested because when someone asks me a question like this, I kind of got to go back through the list to be like, oh, I remember that. Yeah, that was a good one. I'm curious, like which conversations or which guests, or which one in particular surprised you the most? Like which one, when I say surprised you, who that would be?
Look, I think a lot have, and surprise is a function of two things. It's like having low expectations and then being like a really great interview. And I think there are some interviews where we were really excited. Like you mentioned too at the start, Joe Aston and Twiggy Forrest. Twiggy Forrest we'd chased for probably 2 years to try and get him on the podcast, and I think so. Like those ones are great, and you really love them. But it's the ones where you don't really know too much about who you're speaking to. You might have tried to do some research on them and there's not a heap out there. And then you just sit down and you're just wowed by them. And I remember in the middle of COVID was the first time we spoke to Emma Fisher, and we didn't know a lot about her from Airlie. And I just remember, like, I could have run through a wall after that interview. I was so excited about investing. Just the way she just reminded us of like the power of investing and why we do it. And we've had Emma a number of times on the show since. And she was one that really stood out to us at a time where I think we might have just quit our jobs, or like, we were just taking this seriously as a business, and we were like, wow, that was why we do this. So that's one that will always stay with us, I think.
That's a great answer. I remember people telling me about that interview that you guys had done.
Oh, nice.
And yeah, people saying that it was amazing. So kudos. Another one would be like, which of the guests, you don't have to have like a definitive list or anything, mate, but like which of the guests like have taught you the most? And that could be like recurring guests, it could be whatever. Like, is there anyone that springs to mind?
I mean, there's a lot, but without, having to pick one or two guests as the best, I think what I've really reflected on and what I've come away with is, in the same way that, investment returns compound, I think investment knowledge and education compounds as well. And I don't think it's any one guest or any one interview where there was like a eureka moment and all of a sudden it all made sense. But it was this just like ongoing process of learning and listening and hearing different views to yourself and hearing different views to other experts has been the most valuable thing. So it's like the cumulative effect of staying interested and learning and really trying to listen and try and be better myself that I think was really valuable. There's this quote from John Hempton that I always like to trot out. John Hempton, another white whale for the Equity Mates podcast. We haven't been able to get him on. He's told us to, not in these words, but he's told us to piss off a few times. So John, if you're listening, would love to get you on. But he had this quote that was like, every young investor should read 5 investing books. It doesn't matter which 5, they should just read 5. And I think that sums up my view of investment learning. And, you just gotta keep doing it. You gotta start with one interview, book, whatever it is, and the second and the third. And you'll read different views, but the cumulative effect is what matters.
Love that. That's, I'm sure he's listening, by the way. So more circles of influence. No, that's a great point, and I think we're very privileged. Like the spot that you and I find ourselves in is that we can speak to so many great people, and we can kind of compound that knowledge through time. And obviously, everyone that listens can do that as well. Now, so I've got one more question for you, which is my most difficult one that kind of gets people a bit tongue-tied at times. if people, so if people listen to this and they want to go and listen to more Equity Mates, we've got the Twiggy Forrest, Joe Aston, the Emma Fisher podcast. I'll link in the show notes. So those would be, I feel like those are like a great ways for people to jump off or jump into Equity Mates. What else should they be doing? Should they jump on the mailing list, for example?
Yeah. I mean, wherever you are, we will try and be TikTok, Instagram, Facebook. The mailing list, yeah, we're really happy with where the mailing list is at. Summary of the daily news and one investing lesson every day. So that's been a lot of fun moving that to daily. But yeah, I think if you're newer to investing, our Get Started Investing podcast, the first 12 episodes of that were probably where Bryce and I peaked as podcasters. So they're some of our most downloaded episodes still today. So those first 12 episodes you can kind of treat as a series, listen to that, and you might never need to listen to us again.
Yeah, it's great, mate. And that is just absolutely shooting the lights out. The Get Started Investing series, the book, obviously of the same title, and a new book as well. Just one, I think it was like, I can't remember the exact award, but I saw it and I was just like so impressed. So kudos to you. We'll put links in the show notes, all that sort of stuff. But Alec, the last question that I ask guests who are first timers on the show is if you could go back and tell your younger self one thing about finance, business, investing, life, what would it be?
Oh, I mean, I'll stick to investing. Like there's the obvious ones: buy Bitcoin, buy the mega cap tech companies. You don't need to find a small and unknown company to get great returns. The best investments of the last decade were literally staring us in the face. Like we were holding the Apple phone, not buying Apple stock. So those would probably be all messages that I would like to share with younger Alec. But I think for me, there's this one stat that has really stood out that I think has really come to define my investing philosophy more recently. And it's the investing philosophy we really talk about in that second book that you mentioned, Don't Stress, Just Invest. Bank of America did a study they looked at the S&P 500, the US stock market index, from 1930 to 2021. So that's 91 years of returns. And they looked at what happens if you miss the best 10 days of each decade there. If you stay invested in that whole time, those 91 years, the S&P 500 returns about 17,700%. So $1,000 turns into $178,000 or there or thereabouts. If you miss the best 10 days of each decade, that 17,000% return becomes 28%. And that's just because if you get all the bad days in the stock market, but you're trying to time the market, you pull out at the wrong time, you don't get back in, you miss the recovery, you really give away almost all of the returns. And so that stat alone is the thing that now informs my core investment philosophy, which is like, you can't miss the good days. You don't know when the good days will come. So the only answer is to stay invested. And if I could go back to my younger self and just say, put your money in the market, let it compound over time, don't overthink it, well, I'd be a lot wealthier than I am now. So that's what I'd do.
Don't stress, just invest, huh?
That's it.
Mate, that's a great way to end the show. We kind of talked about media. We talked about questions. We talk about the way you guys divide and conquer and investing podcasts. This conversation was long overdue, and so I'm very grateful to be able to do it with you publicly. So once again, thanks for joining me.
Nah, thank you, Owen. I mean, I appreciate all the nice things that you've said about us, but I think the feelings are reciprocal. The business you've built, what you're doing now with funds management, it's really cool, and we're loving watching you build.
Oh, I appreciate the kind words, mate. Cheers.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.